So the 30,500 level to me is that line in the sand. The market on Bitcoin tried to get over it, and it couldn't. It stalled out. We fell. We now bounced. Now we're kind of falling again. So for me, that was a line where I would say if we got above and stayed above, the low of 15.7 is probably the low. We haven't done that yet. So I'm not convinced that Bitcoin has bottomed. And in fact, even though there's so much bullishness out there on crypto, I would just remind people that if you go back to 2018, 2019, there were bounces that were bigger than this bounce in Bitcoin, right? I mean, we had a $3,500 low on Bitcoin. We then went near 10,000 before retracing to 3,500. That's almost a 3x, right? So yes, it's a great bounce, but it's not abnormal for a bear market bounce cycle.
Hey guys, welcome back to Library of Wealth. Today we have master trader Gareth Soloway. Soloway notes that Bitcoin has not yet bottomed out and warns against being overly bullish. While there has been a recent bounce in Bitcoin's price, he notes that it is not abnormal for a bear market cycle to have such bounces. Soloway believes that the rise of meme coins like Pepe and Dogecoin is not a healthy sign for the market, indicating excessive optimism. As a technical trader, he advises investors to avoid gambling and instead invest based on historical evidence. Soloway also compares the charts of Ethereum and Bitcoin, noting that Bitcoin is actually seeing more money flow from the banking crisis, and advises to keep a close eye on the charts in the coming days. Let's get right into the interview with Gareth Soloway. Don't forget to hit the like button and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
And again, just looking back at past cycles in Bitcoin, this isn't super unusual. One of the things that is unusual, and I'll say this, is that the bullishness, and like again, when you're seeing Pepe and some of these other meme coins that are just appearing out of thin air and running so massively, that's not the sign of a healthy market. It's not the sign of a bottom. It's usually the sign of a top. Think back to what we saw with SHIB and Dogecoin in the heights of 2021. That was towards the highs, not the lows, right? And so investors need to just be aware that it's not showing you that we've really bottomed out and we've flushed out. It's showing you that there's still too much hopium in the system, and we probably still have another leg lower to go.
Pepe is like, I'm sure you looked at the charts. You can't look at the chart and figure out anything from Pepe.
No, there's not enough data on it at all. By the way, this shows the power of social media, right? I mean, so many people on social media talking about something and then people just chase it. A lot of people will get hurt eventually, but right now it's been making people money, and it's encouraging people to kind of take risk. But in terms of charting this, I can't do anything with it. You know, it's a vertical move. There's no, for charting, you really need history, and history gives you the ability to draw trend lines and look at past levels of resistance and support, and this just doesn't have it.
You wouldn't take this as an entry point?
No, certainly not. In fact, there's something in the technicals that I use. It's called a time count, which is when you get 7 candles in the same direction. So in this case, green, it's usually the signal of a top. So we have 1, 2, 3, 4, 5, 6. So I would say if again, and I'll never short this, obviously, it's just for me, there's not enough reward for the risk that I'm taking in case it does go higher. But if I had to bet, I would say that tomorrow or today is the top. And I always say to my traders is that when you're investing shouldn't be gambling. If it's gambling, I always say, you know what, go to the casino, you get free drinks, you hang out with your buddies, you have a great time. When you're investing, you're usually doing it by yourself behind your computer, and it's not meant to be a gamble. The odds should be in your favor. And so for me, I have to be able to say, okay, I have X, Y, and Z that show me historically the probabilities of my successful trade here versus just, hey, I saw it on Twitter, so let me buy it. So it's just, it's again, it's a difference between gambling versus investing. Yeah, so Ethereum, so the first thing that pops out to me when I look at Ethereum's chart is the difference between it and Bitcoin, right? So we've seen in Bitcoin where it made this 30,000, the 30,000 high was the high. Here in Ethereum, it was about 2,150. We then had a pullback, and then we kind of retested 30,000. Ethereum never did that. And so the first thing that tells me on Bitcoin versus Ethereum is that Bitcoin is seeing a little bit of extra money flow from the banking crisis, while Ethereum's really not seeing much of that. So that's the first thing. The second thing is you have a very clear bear flag here. We started to break lower. You still have support here at 1,800. But if this 1,800 gives way, you're going right to 1,700 and then eventually to 1,500. So for me, looking at this is much more of a bearish chart to me. Bitcoin to me also has downside, but it's not as bearish as the Ethereum chart. Yeah, so with the bearish comments, that's more related to the equity markets. I continue to be net bearish on Bitcoin as long as it hasn't gotten through that 30,000 level. But one of the things, and I love showing this chart setup here, I want to show you guys this to see if we can take a look here. So if we look at this chart, this is the monthly chart of the S&P 500, and we see this long bullish move, right? Just continual move up, then this bigger pullback, and then this kind of little bit of upside consolidation. So to me, the next move on this chart is going to be the nastiest on the S&P 500. It's probably going to take us down sharply, 3,000 on the S&P, a no-brainer to me, maybe even lower. But again, I would be prepared for the equity markets at least to have a big fall. If we go to Bitcoin, I know you were asking
what was the percentage on that you just had though?
The drop?
Yeah, from that high point to the low point.
For me, this would be a worst case scenario. This would be like the all out depression retrace. But this is the 2000 high, and this is the 2007 high, right? And one of the things and the reason why I have this trend line in, and I don't want to make people freak out too much because I'm not necessarily calling for this in the near term, but in a worst case scenario, generally when markets break out, and we could see the breakout occurring right here, and it just continues up. Usually when you break out of a level, you retrace to that level before going higher. This never retraced because the Federal Reserve was jacking drugs into the system, i.e. quantitative easing. So it never got the chance to fully retrace. So what this tells me is that if you really get the Fed to be sidelined, you could actually head back to that level, which would be an over 50% decline from current levels. And again, that's the worst case scenario, but I think it is a possibility before all is said and done within the next few years. So the way I'm thinking about it is that we are seeing inflation come down. It's going to remain elevated above 3% or around 3% for a long period of time, which is going to handcuff the Fed. However, if things get bad enough, even at 3% inflation, the Fed will absolutely come to the rescue. They'll lower rates. They'll start printing money again. I mean, just imagine if we had 20% unemployment. You can't tell me at 3% inflation, they're not stimulating to get us out of 20% unemployment. So there will be a ticking point. The problem is going to be is that if you stimulate when we're at 3 or 3.5% inflation, where's the next high? 12, 15, 20% inflation. Essentially, this is the beginning of the blow up of the system. Right. So there's only so much that they can do without sending inflation to crazy levels. And eventually later this decade, you do get that depression-ish type situation, that flush out. Mainly it's a little bit further out. So we're still going to see a recession later this year. But my guess is it'll start out to be mild. It'll get a little worse. It'll get to a point where the Fed actually starts to cut rates. And that hopium from investors will get money in. It'll prop up the markets a little bit. It'll help. It'll make money cheaper to borrow. Banks will be willing to lend. So it's going there's stimulative measures that can be taken to just push off that ultimate kind of collapse for a few more years. But again, probably within that 100-year cycle of 1929. So again, later this decade, within a couple of years of that, that's what I would say to watch for.
Soloway believes that the S&P 500 could be headed back down soon if the Federal Reserve were to be sidelined, representing an over 50% decline from current levels. Soloway also predicts that inflation will remain elevated at around 3% for the foreseeable future, making it difficult for the Federal Reserve to take action. He believes that if the situation worsens, the Fed will lower rates and start printing money again to stimulate the economy. He believes a mild recession later this year will get worse, leading the Fed to eventually continue cutting rates, but notes that stimulative measures will only delay the coming collapse for a short time. Soloway warns that a depression-type situation still looms on the horizon. What do you think about Gareth Soloway's latest update for Bitcoin and the crypto market? And what direction he sees the economic landscape heading next? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.